Welcome back, everyone. Thank you all for joining today. I'm just going to hop right into today's video. Today we're going to be taking a look at a company called Nordstrom. Now, this is going to be a fashion mall retailer, sort of a turnaround play. Now, really the TLDR of this whole video and what I'm going to be saying throughout the video, really the whole message behind this is, while it is at a current low valuation relative to the underlying business and the assets, you have to be wary of whether or not this is worth the investment, because I think that there's a lot of business risk and just the debt in general and the leverage is really going to hurt them. And especially with the declining mall business over the last couple of years, not just during the pandemic, I think that there's some risk here when you're investing. So that's something that you want to watch for. This may be the play of if they liquidate, you're still going to make out good. So when you go through your own due diligence, make sure you guys look into this, but I'm going to go through mine today and you're going to see what I think and why I think it and why I think that I'm going to stay on the sidelines for now. I'm not going to invest in this company just yet. I want to see this company play out over the next couple of quarters, but let's hop right into it. Now, this company sells under the ticker symbol JWN, and it is a company that was actually started in 1901 in Seattle, Washington. And I believe that the family that built it originally, the Nordstrom family, I think they're still involved. I could be wrong, but I believe that they're still involved. They at least have equity in the company, so that's kind of important. One of the biggest things is that this is a high-end fashion. This is when you go to the mall, this is kind of one of those high-end fashion stores, especially the actual Nordstrom banner store. There is two separate stores that we're going to be getting into, but they have the Nordstrom store, and then you have Nordstrom Rack. Nordstrom Rack is kind of it's not less premier really, it's just a more affordable version of Nordstrom. And a lot of what they do is they'll take whatever doesn't really sell well in the Nordstrom store and use Nordstrom Rack at a little bit more of a discount price to actually sell those products forward. Now, one of the great things is that they actually have over 200 stores across the United States. I believe it's closer to 300. They have 100 Nordstrom stores and then 248 Nordstrom Rack stores. So that's one of the great things is that people have access to this store. And they've been building their online e-commerce side of the business throughout the pandemic. Obviously, they've been kind of forced to do that. But it is something that is noted because the problem is, as we all know, the decline in mall business, and it's really expensive to keep a mall, like an in-store mall store. And that's kind of what I saw with this business as I was going through my analysis, as I was going through my own due diligence, is that they're going to get hurt if the mall business goes down. Also, one thing to note, on their 10Q for Q3 2021, they had three things that they noted. First one being improving Nordstrom Rack performance just overall. And they also noted increasing profitability and then also digital transformation. Those are the three key areas that they want to focus on for at least the next year, the next couple of years. And that's not surprising because the Nordstrom Rack is probably going to get them more customers. I feel like Nordstrom's prices kind of price people out of their market. You know, you have to go to another store to go find it, like a Macy's, a JCPenney, whatever you're trying to find. And find something comparable that's maybe not Nordstrom, but it still gets you to the end for the consumer at the very least. Now, Nordstrom Rack, again, is going to be that big play, I think, if you're looking into this company. So that is something when you're doing your due diligence, make sure you're looking into that, because I think that that's really where the opportunity is. The Nordstrom company itself really isn't going to get you as far, just because it seems like they're closing down a lot of the mall stores. I've seen a lot of them closing down. So if you're going to get into this, think about the Nordstrom Rack, performance and build out rather than the Nordstrom banner store. Now, that's not to say that there's not an opportunity there, but you just have to remember risk to reward. That's what we're trying to do here. So Nordstrom and Nordstrom Rack, this is how it's going to be broken out on their segments. They're going to be breaking this out on the 10Q and their 10K between the two. Now, Nordstrom's going to include Nordstrom.com, Trunk Club, the Nordstrom branded stores, both here in Canada. They have the Nordstrom.ca, they have Nordstrom Canadian stores, and then Nordstrom Rack Canadian stores, and then Nordstrom Local. Now, as far as Nordstrom Rack, they have NordstromRack.com, you have Nordstrom Rack branded US stores, and then Last Chance clearance stores. They also had another brand, and I'll list it here, but they had another brand, but I believe that they've now rolled it into just Nordstrom Rack. So I don't think that they report on that anymore. Now, for the quarter ended Q3 2021, they had around $3.5 billion between the Nordstrom Rack revenue. And then also for those 9 months for the year, they really had $10 billion. So relative to last year, to 2020, they're doing pretty well. But if you're gonna look at this company, don't compare 2021 to 2020. Compare 2021 to 2019. That's really why anytime you're looking at any of these retailers, especially like the mall or any where they have actual stores, just compare it to 2019, because 2020 is going to be a really off year just overall between the consumer behavior and also just overall performance, because people weren't able to go to the mall and go shopping. So that's going to hit their numbers a lot. But I'll show you guys here what 2019's numbers look like. But just remember, when you're compare 2019, not to 2020. Now, it's not shocking. The majority of what they're selling is going to be women's apparel, and then obviously shoes, and then it goes down to men's apparel. Now, women's apparel and shoes, those are kind of be the two big dogs if you're looking at this company. And if you've ever been into a Nordstrom store, that's not really surprising. I believe that this was originally women's fashion focus, and then they ventured into men's apparel. So if you look at the breakout here, it's not surprising seeing the different sales, but the women's apparel is going to come back, obviously. And we did a video on Revolve, who also had a huge comeback as festivals and different other items of apparel that was needed came back. So anytime you have a increase in festivals where dresses are needed, or even increase in just events in general, people are going to need to go shopping. So that's why it's no surprise that we saw an uptick here over the last couple of quarters. Now, moving on to the financials of the company, they ended Q3 2021. The trailing 12 months is around $13.9 billion. If you look at just the revenue over the last couple of years, though, it's been relatively flat. And I think that that's kind of the scary thing to me, is are they not making enough revenue to really justify all these stores that they have? Because you'll see here in a moment, they're not really making a ton on their bottom line, even though that they have all of these stores and access to all these consumers. And this is a big brand name. This isn't some small company. So for them to not really have any growth in their revenue, especially over the last couple of years, it's kind of shocking to me. And then obviously over 2020, it declined. That's not surprising, but I am happy to see, though, that they were almost able to make it back to pre-pandemic levels, given that, people had stimulus checks, people just were spending in general because they had no student loans to pay and things like that. So that is something to note, but I want you to pay attention to the revenue growth, because that's where the story has to come from if you're going to invest into this company. Now, taking a look at the profit margin, the different gross margin, operating margin that they have, the profit margin, generally speaking, before the pandemic happened, was around 2 to 3%. And it didn't really go that far away from 2 to 3%. So that's something, if you're paying attention to this, 2 to 3% really is not a lot, especially because they have all those stores, they have to pay that rent. It's not really a lot for them to go with. So if you're only getting 2 to 3% on your bottom line, and they actually had a dividend before, and that was probably to keep investors, and they got rid of their dividend when the pandemic happened, so no shocker there. But 2 to 3% on their profit margin, that's not a lot. Even we just looked at Revolve, and they're an e-commerce business that's selling high-end fashion. They're around 10 to 11%. So if we can make 10 to 11% versus 2 to 3%, does this justify the valuation? That's kind of the ongoing question. Now, their gross margin for the last quarter was 34%, so that's decent. And then obviously their operating margin was around 1.5%. So again, look at the margin expansion if you're going to get into this, because if it only tops out at 2 to 3%, it's not really worth it at current valuations to pay for this business. But you're going to see here in a moment kind of the other valuation metrics that we're going to be going through. Now, for the current PE, it's around 293. Obviously, if their earnings went negative last year and they just broke a profit this year, obviously it's going to be huge. I believe the forward PE on it was around 9 or 10, I think is what it was at. So if you're looking into this business, you're going to have to believe that they're going to grow their profit back to at least what it was before. If it doesn't, that's not good for your metrics. It's not good for growth opportunity. So, but right now the PE is obviously going to be 293. Along with that, their enterprise value to EBITDA is around 7.6. So it's a little high, but their enterprise value is really high just because of the amount of debt that they have on their balance sheet. Now, their current cash position has been going down. It's around $267 million right now, but it has been going down, especially over the last couple of quarters. So if they're issuing debt, their cash position's going down. You have to think that they need to survive the pandemic, and they have to do it through financing. So there's going to be three ways that they're going to do it. They're going to either raise debt, sell shares, or a combination of the two. They don't really have enough cash to just, plow into their business to survive all this on its own. It's going to have to come from somewhere. I've been seeing on the cash flow statement that it's been coming from issuing debt. So if they're going to issue more and more debt on the balance sheet, you want to pay attention to that. Now, as far as the inventory goes, they do have $2.863 billion of inventory on the balance sheet. So that's a huge plus. If they have to liquidate the business, you want to make sure that that inventory is above their debt levels, which I believe in this case, it was right next to it. So that's something you want to pay attention to as well for at least these like retailer businesses that sell in the mall. Now, last but not least, you had total debt, and this is going to be the debt that they pointed out in their balance sheet. This is $2.851 billion on their balance sheet. And of course, like I mentioned earlier, they are growing this debt. They have to pay for something, to pay for the business somehow, and it seems to be coming from this debt. They are aware, though, that they want to keep their credit rating. They want to keep the business healthy, so they don't want to issue too much debt. But again, they're in mall stores, they have operating leases that they need to pay, and they also have a lot of e-commerce and inventory that they need to take as well. So if that's the business that they're going to be getting into, they might be able to manage better if they focus more on e-commerce. But I want to pay attention to what's happening with the in-store businesses. How much money are they paying towards these stores when you have other companies like Revolve who are using e-commerce as strategy and they're not paying all that much. So that is something you want to pay attention to. Now, as far as the industry goes, McKinsey.com actually pointed out that travel has traditionally been a key driver of luxury spending, but international tourism is not expected to fully recover until the end of 2023 into 2024. So the recovery will be uneven between all the different states and all the different countries. And so this will affect the retailers differently. Now, for Nordstrom's sake, people are going to go out and spend money on luxury goods if they have the money. So that is something that you want to pay attention to. And then also, many of the companies have employee retainment issues, and this isn't just, this isn't just due to Nordstrom, this is just industry-wide. Why would you work? People aren't working minimum wage because they don't have to anymore. And so if you're going to have a lot of money going into training, going into minimum wage increases, going into just salary increases in general, you want to pay attention to this. Now, McKinsey did note that actually they're seeing a tick up in social shopping, kind of just social media related shopping. And one of their recommendations was actually to double down on online retailing and actually, get into the e-commerce game. And that is something that Nordstrom has pointed out that they want to do. So that's very, very good to see. Now, the couple of strengths that I want to go over, and there's a couple of risks I want to go over. The first strength being their brand and reputation. It's Nordstrom. Everyone knows Nordstrom. People love Nordstrom. It's not shocking that Nordstrom is just such a huge brand because it's been built out over the last couple of decades. So Nordstrom is seen as a high fashion, high luxury retailer, especially in the mall if you want to go there. A lot of people will go shop around, just see if they can find anything. And the nice thing too is that they sell private label and branded products. So people can just go buy the branded products if they're looking for it, but they can buy it in Nordstrom because they like Nordstrom. Also, Nordstrom Rack is this new up and coming more affordable option into sort of high-end fashion. So a lot of people, both male and female, are actually getting into these stores, and there's a lot more foot traffic that's being driven into the Nordstrom Rack store. So when you're looking at this, look at this from the approach of, is there an opportunity to grow this brand further and grow Nordstrom Rack, and as well as just a digital piece of this name. So that's really where that first strength is going to come from, that brand and reputation. Now, the second strength is that they have recognized that digital growth is the way that they need to go. It'll reduce the cost, just the operating leases don't cost as much. And it can increase their margins if they're able to get in the e-commerce more and more. If they can keep the returns low, or at least let people just return to the, you can buy an item online but return it to the store kind of thing, that'll actually even be a better opportunity to kind of double down, because if they return something, they might just walk around the store and buy something. But digital growth is another strength that I think that they're going to have. They had, I think it was 40% of their sales for Q3 2021 was digital sales. So obviously people are still buying online. People love to buy these products online. But again, the in-store sales and foot traffic, that might be dwindling down. So it's something you want to look into further if you're going to keep going and doing your due diligence into this business. Now, number 3, I had this one listed as a pro, kind of a pro and con. Pro being they have a large physical store space. I know I've been harping on the fact that they have a lot of physical stores, but there's something to be said when you go to the mall. If you're one of the premier stores there, people are gonna go in there, especially if they're spending a lot of time at the mall and they're not just going to one store and they just want to walk around the mall. They're gonna probably walk in Nordstrom. So if you're going to the mall and you're seeing that foot traffic sort of drive up and up and up, that is something that I really want to pay attention to as well. The only con is if they're not making enough sales to cover these leases, to cover this rent that they're paying, that will hurt the business over the next couple of years and really just over the long term. So when you're looking into this, the declining or the increase in foot traffic for the mall in general, and just different locations obviously will perform differently, but just the overall sentiment around, the mall as a whole. So I kind of had this last one listed as a strength and a weakness. It's just something that I wanted to point out because I feel like people do like to go into stores a lot, and if it's one of the stores that you see at the mall, it's in the back of your head regardless, even if you go in there. Now, the risk for the business, the risk. This is something that I could have probably put a lot more on here, but I just kind of picked some of the major ones. So obviously, like I mentioned earlier, the total debt that's on the balance sheet. Now, between the cash and the inventory, I believe they have enough to cover this debt in some liquidation or something like that. But covering inventory would be super hard across all their, just across all the stores and just everything. So I don't know realistically if that'll, cover it. I do think the leverage that they currently have on the balance sheet, it's scary. Don't get me wrong. It is scary to have $2.8 billion, and that's increasing. It's not going down. That is definitely increasing. So when you're looking into the business, look at the total debt, look at what is actually happening with the debt, and focus on the earnings calls and the earnings releases to see if management's talking about this debt and this leverage position that they're in. Because if it keeps increasing, if it's any downturn at all in the economy, in the consumer spending, anything like that, this company is going to go down in a downward spiral. So that's why with this one, valuation is super, super, super important. That risk to reward needs to be there for you. Number 2, this is more of a macro kind of risk, and I already mentioned it with the industry, is the fact that people are going to be spending less just in general because of they have to pay off home loans, they have to pay off student loans, they don't get stimulus checks, they're not getting bonuses from the unemployment or anything like that where there's just extra money in general flowing around. Because even if the person who's getting, the boost doesn't necessarily spend more, they just have more money to spend in general. So other people are taking out loans, they're using their credit card. So just pay attention to this. I'm serious. Like the consumer spending overall has been pretty hot the last couple of quarters. So if that starts to dwindle down, it's going to hurt the recovery and turnaround for Nordstrom as a whole. Now, number 3 is the decline in mall business and just the general mall, not Nordstrom specific stores, but just the general mall. Payments.com pointed out a research article that shows that mall traffic is down, the foot traffic is down around 6.5% at indoor malls compared to 2019. Not shocking, COVID's still a thing, so it's not really that surprising, and it's down 5.5% or 5.2% for outdoor malls. That's a pretty steep decline over the last couple of quarters, just really last year and a half. If this doesn't come back, and it stays at sort of a lower level and doesn't really creep back up, that's going to hurt them. But again, we don't have international tourism, so that is part of, foot traffic that goes into these malls is the international tourism. So maybe as borders open back up and people start flooding back in to go on vacation here, we might see a little bit better of a tick up. But for now, again, I can't get past the fact that the mall business is really something you want to watch. And then lastly, the increase in supply and labor costs. So from supply costs, this is just inflation in general, really. We've seen raw materials go up a lot over the last couple of quarters. And I also think that just labor costs in general, because they're increasing minimum wage, companies as a whole are paying a lot more. So if you're competing with other companies now to retain employees because you're only paying minimum wage and another company is going to set their minimum at, $20, $25 an hour, you're going to lose a lot of people to that company. So if Nordstrom can't compete in retaining employees and talented employees, they're not going to be able to survive in the mall business at the very least. They might be able to survive on the e-commerce side, but we're going to have to see how that digital shift really happens. Well, now we're going to be moving on to the discounted cash flow, and if you notice, this looks a tiny bit different. I had to re-record this because actually some of my calculations were wrong in the original piece that I did, so I'm going to hop into the new revamped version. Now, the first thing I want to point out, obviously, you have your current shares outstanding, current revenue. The current share price at the time of making this video was around $20, and then obviously you have the current market cap, you have the fair value, the upside from the current price that it's at, the current free cash flow, current net debt, net income. Now, if you look at the ratios, the current PE and current free cash flow, obviously the current PE is going to be super high, and the current price to free cash flow is going to be super negative because it's been a bad last year and a half. So 293, that's not really that shocking. I think in the future it'll obviously come down as our earnings go back in line with their historical value, or maybe not, but we'll have to see as we price that in. We'll see what the outcome really is. Now, as far as the shares outstanding, we have 1.5%, 1%, and 0%, 0% being on the high side. I still think that this is a little low for what they're actually going to do because they're going to have to issue shares. They're going to have to issue shares to finance a lot of this, and they probably won't want to do a lot of debt. Now, you also have the revenue growth. I decided on 1.5%, 2%, and 3%. Then you have the profit margin. You have 2%, 2.5%, 3%. Free cash flow margin, you have 1.5%, 2%, 2.5%. Then obviously for PE and price to free cash flow, I did 10, 12, and 15. I think these are probably a little bit more normal. This isn't really a high growth company, so you don't want to be paying a ton on terms of the multiple for this company. Now, the discount rate is going to be 12.5% all the way across. And the best way to look at this, I'm going to call this the everything money indicator because it's something that they created, and I feel like it's super important. You have three cases. You have the worst case, base case, best case. You can see based on my numbers, on the net income side, the $21.94, that's what the base case is going to be, and then obviously the best case, $33. And then for the free cash flow side, the base case is going to be $17, and the best case is $28. Now, the percentage you see at the bottom, that's the current stock price versus that fair value. So that's something to look at, and I think that you want to be in between the worst case and base case. Honestly, the best case scenario, though, you want to be in front of the worst case as well. So you want everything to be positive in terms of the upside. That's when you can find the best deals. Now, I did my own kind of free cash flow as well, and what I got was a price of $18.64. Now, while even if it drops down to that, I don't think I'll start investing. I need a large margin of safety on this one because, again, the mall business is kind of scary. You have a lot of debt on the balance sheet, and I just think overall this is a very slow growing company unless they can see some sort of margin expansion from that e-commerce side of their business. So if they can build that out and the digital transformation really works out, this could be a good turnaround play. But as far as my closing thoughts, I'm going to wait a couple of quarters, maybe even a couple of years to see what this actual turnaround is going to end up being. It's something I'm going to track. I really want to pay attention. Nordstrom's an easy business to understand, so it's an easy business to follow. You don't really need to do too much in-depth research to really understand and grasp how this business makes money, but from investor point of view, the value in this needs to be added with a margin of safety. So if we see a huge drop like we saw in the COVID crash of March 2020, that might be an opportunity to pick up some shares because honestly, this could be the case that if you liquidate the business as a whole, you'll still make out good. But anyways, guys, thank you guys so much for watching. I hope y'all have a great day. Let me know if you have any more stocks down below. Make sure to hit that like and subscribe. And as always, this is me, Joshua Castillo, signing off.